Stocks are down big. These are the 5 most requested stocks we've had on our channel since we started the channel. PayPal, Intel, Alibaba, Apple, and Meta, also known as Facebook. We're going to do our 8-pillar process. And then for each stock, we're going to use our stock analyzer tool to determine what price to pay for the stock based on our assumptions we are making about the future. So if you have our software, load it up. Let's get on here and let's look it up. First stock, PayPal. So PayPal, $91.65. Let's look at the 5-year chart. Holy cow, over $300, and the 1-year high is $295, and the 1-year low is $70. So I love looking at stocks that are down a ton, because usually if they're down a ton very quickly, there's probably some irrational reason for it. My personal opinion is I want to look at them and evaluate them quickly and see if it's even in the ballpark. So no dividend to look at. So let's just go right to the 8 pillars. Oh boy, I love this. So why do I love this, guys? We've got 2 X's. They are our valuation metrics, the 5-year PE ratio and the 5-year price to free cash flow ratio. This is where I take the last 5 years of earnings, the last 5 years of free cash flow, and I take them and divide them into the market cap. And I want it to be under 22.5 for each. Now, does this mean you ignore it? Not necessarily, because remember, PayPal has a lot of growth potential. They're worldwide and they're growing, and they've recently announced their focus will be on profitable growth. Before, they wanted to grow at any cost. Now they want profitable growth, which I love. So I'm not discounting PayPal quite yet. FacePal. That's a new company I'm starting. It's going to be a merge between Facebook and PayPal. So they are buying back shares, which I'm not a huge fan of as it's expensive, but that's okay, because they were buying back shares probably when they were $300 a share as well. High return on invested capital. Great increase in revenue. Look at this terrible net income growth, 19 million off of 12 billion. But their free cash flow growth was awesome, 5.4 billion. So this tells me there must have been some sort of write-off or something in the last 5 years. So let's go check out the income statement real quick. Let's go see if there was a big drop. All right, there was a $1 billion other income and expense right here. Oh, I'm sorry. So that's not bad. We're good. There was a big jump last year. Okay, so I would look at this increase in revenue not leading to a huge increase in profit. Make sure you understand why that is. You would think that with such a high margin business, let's look at their gross margin. Their gross margin is 51%. That means for every extra dollar they sell, they add 50 cents to the bottom line. So they're going to obviously add some overhead as time goes on, but you should expect that if they increase revenue by $10 billion, you should see a couple billion being added to the bottom line after also increased overhead. But we don't see that here. I kind of maybe like that. Is it an opportunity that they're using to grow internally and get themselves ready for more growth? Who knows? That's one major question to ask. So let's go use our stock analyzer tool. Now, guys, if you're new to this channel, I'm Paul. I'm a value investor. My goal is to use the 8-pillar process to make assumptions about the future, because every investment is the present value of all future cash flow. And I want to find a situation where price and value are disconnected like this, where the value is higher than the price. It's hard to do emotionally, but if you can do it and do it across 20, 30, 40 companies and do it well, you can beat the market. That is my goal. I use the stock analyzer tool as my screening process before I go further and do more research. Once I like the company from the 8 pillars, I put my assumptions in the stock analyzer tool. And if I get a lot of green, I go do my research and make sure I like the company. So when you're watching this video, please rewind the stock analyzer tool part, because I'm going to do the very thorough one for PayPal to explain my thought process for every line. I want you to make sure you understand this. And if you have our software already, if you're one of the smart people in our community who pays less than a cup of coffee per day for it, follow along. It's a great way to learn. So first off, 10 years of analysis. I can do 1 to 20. I'm picking 10. And I do 3 number of assumptions, low, middle, and high. So guys, in the last 10 years, they did 18% growth, 16, and then 10.7. So it's slowing down a little bit. I'm going to make very conservative assumptions. How can they grow just organically? So let's do this. Let's do 6, 9, and 12% revenue growth. Now, profit margin. Now, there was no profit margin here for 10 years and no free cash flow margin. But we have profit margin of 14% over the last 5 years and 8% over the last year. Now, keep in mind, guys, they probably spent a lot of money acquiring users. And my guess is, and I can't verify this, my guess is they probably put a lot of those expenses inside their net income and wrote them off immediately. So I want to give them a little bump to that profit margin, especially with such a high gross margin of 51%. So I'm going to sit here and I'm going to put in 12, 15, and 18%. Free cash flow. Actually, you know what? I'm going to go higher than that. You know why? I look at that free cash flow, and free cash flow and earnings should be pretty similar over long periods of time. So I kind of like that free cash flow number. So I'm going to go a little bit higher. I'm going to go 14, 17, and 20. I'm going to do the same. I'm going to do 15, 18, and 21 for free cash flow. Now for PE and price to free cash flow, they're very high right now. And this is asking you what PE and price to free cash flow do you want to apply to it at the end of your 10 years. Now remember, at the end of 10 years, they're going to be a much bigger company. It's harder for bigger companies to grow faster. And I believe 2 reasons to pay a higher multiple for earnings and free cash flow is growth potential and moat. There are a lot more players in the space of online payments and things like that. There's Square, there's Stripe. Now, granted, PayPal owns Venmo. So the moat might be not as great as people want. So I'm going to sit here and I'm going to put in 13, 16, and 19. Actually, 13, 15, and 18. So it's not even, but here's why. As they grow and grow and grow, I'm hoping that they become more, they're a very reliable vendor to payment processing. When I buy things, I just bought a pair of shoes an hour ago. Given the option, directly charge through my credit card or pay on PayPal, I picked PayPal because I know PayPal is really going to support the consumer a lot. There's a lot of protection. My counterparty on this channel, Mo, when I said this to him, he goes, oh yeah, you're right. I always pick PayPal when I want to buy something. That to me is a very sticky thing. Today, I've paid probably 9 people through Venmo. That's what I love. I pay probably 10, 12 people a week through Venmo or PayPal. Just direct people I know. Hey, do you have Venmo? Do you have PayPal, etc. So that's why I love it. So I'm going to do the same thing for price to free cash flow. Now the last line is desired annual return. Now remember, if you buy a low-cost ETF, you can get 9 or 10%. But if you're going to buy an individual stock and you want some margin of safety, you got to go with a higher desired return. Because remember, the more desired return you get, the higher return, you have to pay less for it, right? Because that's how you get a higher return. You get a higher return by paying less for an asset. So which ones I'm going to pick? Now, I believe these are very, very conservative numbers. So I'm going to pick my lowest desired return. I'm going to pick 12.5%. And as I go higher, I'm getting more aggressive. So and there's less likelihood that these happen. So I want a higher margin of safety. So I'm going to go 15, and then I might go, 15, and then 17.5. Now, guys, I'm going to hit the analyze button. Here's what I want you to do. If the numbers are all green, there's going to be 6 numbers that pop up. 3 based on earnings, 3 based on cash flow. If they're all green, this does not mean go out and buy it. It means go verify this data. Go verify that these assumptions are correct. The next question you're asking is, well, how do I verify that? Several ways. Google, go find other people's ideas about it, pro and con, against or in favor of PayPal. Go see what analysts are saying. Even though I don't believe in putting a lot of credit to analysts, oh, and by the way, we have analyst estimates on our site right here. So you can actually go here to our analyst estimates page, and it'll show you their earnings per share estimates for the next 5 years and revenue share for the next 5 years. So when it comes to this, the biggest thing you can do though, and this is why we talk about this, is our software. This EM community has thousands of people in it every single day talking about investments. And I assure you, people in there either are or have talked about in the last week PayPal. There are thousands of people and they're active users. This is why we created the community. It was so hard for me being a value investor back in the day because I had no one to talk to. It was just me. So I was bouncing ideas across myself. This one allows people, thousands of people every day to talk. They talk to me, they talk to each other, they do all of this. This is all available for less than a cup of coffee per day. And not only that, you get all of these tools and all the tools that are coming. You get a watch list. So even if this company isn't where you want it to be, you add it to the watch list, pick a price, and it'll notify you via email, which I got today on the stock, your phone app, because this software is all available on the phone, and through the website to tell you the stock has hit that price. Guys, it's a no-brainer. Go to everythingmoney.com, and trust me when I say you will never regret it. And let me show you exactly what you get with the software, because it's pretty awesome. You get all of these things: mobile app, 8 pillars, 30 years financial data, stock analyzer tool, exclusive daily content, access to Mo and I, real estate calculator, stock screeners, retirement calculator, EM community. All of this is available for $29 a month. And our competitors are $199, $199, and even $35 a month. It's a no-brainer. So back to this. We hit the analyze button, 91.84. Boom. All right. The low price, a little under 50. High price, actually pretty close, 86 to 90. Middle price, not far off. Because remember, guys, this stock was at 300 and some just a year ago. That's the amazing part here. So I'm interested in the stock. I might actually go a little bit higher here. I might put myself an alert for $70 and notify me then. So guys, we've done this thorough. Please rewatch if you want to, but if not, let's go to the next 4 stocks. Let's go to Intel. All right, guys, we're going to Intel. Now, Intel is one, in full disclosure, that I own. I'm not telling you to buy it. There's no endorsement whatsoever. Intel, this is a long-term turnaround play for Intel. Intel's revenue fell 17% in the last year. By all means, you need to do your own research fully. So Intel had free cash flow loss of $1.6 billion last year. The 5-year average is 12.6. And the issue we have is, look at this dividend. It's a $5.8 billion dividend. So is this dividend secure? Because they don't necessarily have the cash flow in the last year to pay for it. That's a very important aspect you need to look at the company, okay? So let's go to the 8 pillars. Used to be all green check marks. Now it's got a return on invested capital is down. Why? Because their free cash flow is down. And their free cash flow is down. Why? Because their free cash flow is down. So Intel is currently down, wow, 31.64. I remember just the last year and a half, it was at 60 some bucks. Analyst estimates. Now, even though they're struggling, analysts are still projecting out growth in EPS. And remember, guys, these are the analyst numbers, analysts covering them for these years. Keep in mind, there are not 43 analysts covering Intel. There's probably 430 or 4,000 analysts. So our website pulls from a data feed, and it's those analysts. By all means, go to other websites, see what they're saying. And the revenue numbers, even though they've fallen a lot, they still expect growth over the next 5 years. Very low growth. Very, very low growth. Low single digits. So let's go to our stock analyzer tool and see what we're going to do here. So I'm going to do 0. No, I'm going to do -1. I'm going to do 2. And I'm going to do 5%. And here's why I'm going as high as 5. They're building a $20 billion factory in Ohio. They're building another factory. This whole chip thing just came out with Congress. And I think this new CEO has the right track of how he's going to grow the business. It's not for sure, but we'll look at that. Profit margin. I'm going to go with 20, 22, and 24. Free cash flow margin. Now, this has been affected lately, and they've even announced that their free cash flow is going to be a lot lower as they reinvest back in themselves. So I'm going to go with 15, 18, and 21. Now, PE. The current PE is 7. I'm going to call it 9, 12, and 15. Because I do believe if it gets to the point of growing 5% a year, it's a big enough player to be able to get that 15 PE. And for my annual return, I'm going to do 12.5, 15, and 15. 15 and 18. 17.5, sorry. Hit the analyze button. Okay. So we have half green, half red. We have a low of somewhere in the low to mid 20s, a high of 40. And this is a lot lower than it was before for me. So I have to reassess this company because before I thought it was a $60, $70 company. So this is when I have to reassess. Next company, Alibaba. Also a company that I own, but again, not endorsing it. Do all your own research. This is very important for this company. Now, the reason Alibaba is down a lot, and all Chinese stocks are down a lot, is there's threats of delisting. A couple weeks ago, China and US regulators were able to get together and come up with audit requirements for Chinese companies in order to make it better for them overall to stay on US stock exchanges, because that was the issue about delisting. China was pushing back on allowing auditors in China to audit the companies. So the stock is down $2 today. The high was 182 a year ago, and now in the low is 73. Let's go to the 8 pillars. Oh, wow, interesting. All right, so net income has fallen, and shares outstanding have risen, but very low debt, 1.9 times the 5-year average free cash flow. And what I like here is still growing free cash flow. 5 years ago, 18 billion. Last year, 20 billion. Low price to earnings ratio and low price to free cash flow. Let's go look at those analyst estimates. Now, this is based on their, we have to get this converted, but this is based on the Chinese currency. But they still do see over a 50% increase over the next 5 years. And revenue-wise, again, Chinese currency almost doubling over the next 5 years. So it's pretty impressive here. And we get our data feed in another currency. So by the time this comes out, this is not available to users yet, it'll have the conversion over for you. Now let's go to Stock Analyzer tool. All right. Revenue growth. Look at that 10-year revenue growth, 43%. We're not going to go that high. We're going to go 6, 9, and 12. Remember, China has the fastest growing middle class in the world. That place is growing like crazy, and their middle class loves freedom and loves their income. So that's a good thing for Alibaba. Profit margin. I'm going to do 14, 17, and 20. Free cash flow margin. I'm going to do the exact same thing. PE. I'm going to go with 13, 15, and 17. And same with price of free cash flow, because even when they grow, they still have the fastest growing economy of a developed nation with the fastest growing middle class of a developing nation. So I like that, and I'm willing to give them a premium for that. Desired annual return, I will say 15% though, all across the board. And the reason being is there's still these issues. Now, I'm okay if I lose my shares to Hong Kong Exchange and they go to Hong Kong. I'm fully fine with that. I've talked to Merrill Lynch, people who hold my money, and they said, Paul, if Baba goes back to Hong Kong, you just get shares in Hong Kong, you're fine. So I'm okay. In fact, we've had some people in our community message me recently and said, actually one messaged me yesterday and said, Paul, I converted all my shares to Hong Kong shares already. I just want to get it over and done with. I was like, oh, interesting. Hit the analyze button. Boom. We have a low price of 80, a high price of 200, and a mid price of 128. So guys, do your research on this one because I think it's in the ballpark. You can start sitting here and, I mean, it's getting close. It hit a low of 73, so it went below that low price. And I do think my revenue estimates, as you can tell from the analyst estimates, are very low. All analyst estimates are above my low range. Okay, what's the next stop? Apple. Apple in the house. All right, so Apple is a darling of Warren Buffett. He's buying it. Is he buying it at these prices? I doubt that. I think he's buying it sub 140, but we'll find out in the future what he does. They have a 0.6% dividend that pays out $15 billion. And their 5-year average free cash flow is $78 billion. And last year they did $108 billion. Guys, this company is absolutely immersed in our lives. Like they own our lives. 8 pillars. What I love to see, except for valuation. Big valuation numbers. Everything. In fact, I don't even like them buying back shares at these levels, but they do it because they spit off so much cash. They don't know what to do with it. And their debt is super low. So everything else, green check marks. They have a huge return on invested capital. So let's get right to it in the stock analyzer tool. All right. Revenue growth. Let's see what the analyst estimates. Sorry, let's go to analyst estimates first. So look at this, guys. Look at earnings. They're not jumping up that much. Low single digits, low to mid single digits at best, according to analysts. Same with revenue and declining revenue growth every single year, basically, except for the last year. So fact that in here. Stock analyzer, revenue growth, 2, 4, and 6. Profit margin, 21, 23, 25. Free cash flow margin, 22, 24, and 26. PE, 13, 15, 17. Now, I do think that Apple can probably justify a higher PE because of their moat. I mean, they literally own our lives, which is an incredible thing. I mean, they literally have every aspect of our life in there. And I'm actually going to go with 12%, 14%, and 16% here. Hit the analyze button. Yep, it's got to fall a lot. You might sit there and say, Paul, that's crazy. A low price of 60, high price of 80, mid price around 70. Okay, but look at this. What's their PE? 25, 24. It has a huge moat. So I understand why Warren Buffett's buying it under 140. I can see it because they have billions and billions of dollars sitting on the sideline. And this is a great brand and a great company. And his job is to deploy capital and get a reasonable return on his money. Even if you look, but I still don't get the price. He sees something I don't see. Even if I change my desired return to 10%, I'm still only there on the high side of 120. But if they use their cash to buy back shares, paid back to investors, it could really pay off. Final stock, Meta. Spoiler alert, I got Meta too. But again, do your own research. Do not buy anything because I buy it or for any other reason that anybody else buys it. Always do your own research. There are great investors out there I disagree with. Warren Buffett owned Verizon 2 years ago. I was like, I don't get why he likes Verizon. I'm not going to buy it. He liked Apple at 140. I don't own it at 140 and I'm not buying it at 140. So things like that. Oh, wow. Facebook's actually up today. Meta's actually up today. In a down market. No dividend, increasing cash flow. Let's look at their 8 pillars. Oh, I didn't know this was an 8-pillar thriller. Look at this. Everything. 8. Look at this debt. So low. They can pay off all their long-term liabilities with less than 1 year of their 5-year average free cash flow. Holy cow. What are the analysts saying? Because, Apple basically shut out a lot of costs for a lot of revenue for Facebook. So, but look at this. Earnings per share. People are still looking at growth here. Not huge, but still double digit. Revenue. Still growing. Why? Guys, I don't think Facebook's maximize its per user revenue numbers. And they have 3.5 billion active monthly users across all their platforms. Guys, there are 7.8 billion people in the world. Almost half use Facebook on a monthly basis. They have not, this is an incredible achievement. So let's go to the stock analyzer tool. All right, I'm gonna ignore all the past revenue growth numbers. I'm gonna go 3, 6, 9. Profit margin. Now they're going to spend some money in the next 10 years with Meta. So I'm going to go 25, 27, 29. Same thing with the free cash flow. I'm really going to drop it down. PE, go 12, 14, 12, 15, and 17, which is same with price of free cash flow. And for my desired annual return, I'm going to do 12.5, 15, and 17.5%. Because I think 9% will be very, very difficult for them. Hit the analyze button. The stock's currently at 163. All right. High side 188, low side 125, mid side 160. Now, if you've watched past videos, I actually think the stock is worth more than that. But I'm trying to be super conservative, and I'm trying to sit there and figure out, like, look, if I put 10% in here, what I think the stock's actually worth, it comes out to much higher numbers, right? So your decision is what kind of margin of safety you want to do. If you like this video, I appreciate your time. Please watch our next video on our margin of safety and how I look at it, and please subscribe to our channel. Thank you very much for your time.